Hey there, John.Hunter. I'm coming to you this week with a topic that is near and dear to my heart. It is the reason why VA loans are awesome. So, VA loans are special to me. You might hear me talk about VA loans a lot here on the channel. I do. It is literally my favorite loan to do, but a lot of you don't know why. My father was a career military man in the Army for 24 years. He served in Vietnam. He won the Bronze Star, the Air Medal. He was shot down a few times in helicopter. He served on the Joint Chiefs of Staff. He was retired as a full colonel. He was a very dedicated patriot, and I grew up with that. And giving back was important, and obviously he felt very strongly about taking care of vets and the people that are under his command. And I, in a small way, have tried to give back since I've been a professional. I love VA loans. I try to take care of veterans whenever I can, and it's important to me. And it's something that I will continue to do throughout my career. And like I said, I have a special place in my heart for that. So that said, there are 6 specific reasons why VA loans are better than any other type of loan. And stick around to the end of the video, because the best reason I'm saving for last. It is my favorite, and I do believe that you'll agree. So, and if you're a veteran and you're thinking about buying in the next 6 months, maybe you were thinking about pulling some equity out of your house, refinancing when rates come back down here next year, or possibly purchasing, and you have some questions about how to get ready or what guidelines are, that type of thing, how much you might afford. I have a calendar down below in the link. Feel free to make an appointment. We can talk for 10 minutes, no obligation, clearly. And I can help you get ready for, whether it be a family member, yourself, even if you're not a veteran, right? If you have questions, I'm here for you. That's what it's all about. So, all right, let's talk VA loans. Now, zero down is the number one reason why people love VA loans, right? And who wouldn't love it, right? So it's the true zero down loan. Like, there are other zero down loan options out there, but they all come with restrictions, right? Biggest one is most of them come with income restrictions. If you make too much money, you can't do it. Or they'll have loan amount restrictions, right? Most of those zero down loans will only go to conforming limit, which is usually anywhere from, 700,000 to 900,000, somewhere in there, depending on if you're in a high cost area or not. So it's very restricted. Now, VA loans, they don't have any of those restrictions, right? So you can go zero down as high as you want, which is the number 2 reason why VA loans are great, which is no loan limits. So VA loans, well, they'll go zero down to $3 million, right? Without any of the added restrictions that you see with jumbo loans, right? Because if you're a conventional buyer and you get a loan that's over $1 million, chances are you're going to have to put 20% down. Now, there's few exceptions there, but 10% might be the minimum, right? But VA will go zero down, right? You don't have to have perfect credit. Where jumbo loans require 720 typically and above. Some will go 700, but you pay a huge premium for it. You don't on VA. Doesn't work that way. So the no loan limit thing is crazy. They changed that back in 2020. It used to be much more limited, right? Where you could go zero down up to $1 million, and then you had to put a down payment over that. And there was a formula to it. But that's not the case anymore. If you have full eligibility, there is no loan limit, and you can go zero down. One really cool factor with VA that sets it apart. Now, underwriting flexibility. This one's big. Now, back to the loan amount thing, underwriting flexibility, credit scores, right? They are very forgiving with credit score. You don't get whacked on the rate. Like conventionally, if your scores are below 700, you start paying a huge premium just because of the credit score, right? VA doesn't have that type of a tiering, right? You're 660 and above, and you're pretty much getting the best rate that VA has to offer, right? You get below that, there's some small adjustments to it, but it's not huge. VA is super forgiving, right? Where conventional is going to be looking at, say, like 7 years for foreclosure, right? VA is 2. But here's even the cooler thing, and these are the nuances that are just, I love about VA, right? I get into the weeds on this, right? I kind of dork out really about it. But VA looks at when you fell into foreclosure is when they start that 2-year date, right? Conventional looks at when the foreclosure actually occurred, which, if you know anybody or if you've ever been through that process, when you fall into default, there's a notice of default that's given, 90 days passes, then they do a trustee sale date. Oh, that could be months, sometimes years down the road. Then when they finally foreclose, you could be 1, 2, 3. I've seen it as much as 4 or 5 years down the road before the bank ever does anything as far as formally foreclose. Well, conventional waits till that date, and their 7-year waiting period goes off of the actual foreclosure date. Where VA looks at, well, when did you fall into default? When did the default occur? Well, that happened right away. That's 90 days in, right? VA will go off of that default date, and it's 2 years from that date is when they go off of. I mean, it doesn't take rocket scientists to realize that you could literally get another VA loan very often before your waiting period has even begun on conventional or FHA or USDA or any other type of loan. The rest of them all go off of the actual foreclosure date, not VA. All right, that's a rule right there that kind of encompasses the make sense approach that is so veteran friendly with VA loans. Literally at every turn we find guidelines like that, right? So, that's just a small example of the credit piece that just makes sense, okay? Income-wise, they will let us go much higher debt-to-income ratio-wise as long as it makes sense, right? We have to do a residual calculator that in layman's terms means we just have to make sure we're leaving you enough money to live on, right? They have a little formula that says, if you're a family of 3, you need X amount of dollars. If you're a family of 4, it's this much. As long as we meet that residual plus typically 120% of that, they're really flexible with that. And no other loan even comes close, right? Especially when you start talking about larger loans, or like jumbo loans. Debt to income ratio on a jumbo loan, most lenders, I mean the vast majority, like over 95% of them, are going to restrict the debt to income ratio to a 43 or below, right? Where VA will go 50 plus, right? Plus there's no mortgage insurance, so your payment's already lower. The interest rate on VA loans is better than conventional or FHA with no mortgage insurance. It's just night and day. So loan to value too. We talked about the zero down, but did you know that VA will do a cash out refinance up to 100% of the value? Now, there is a rule though that says they'll do 90% all day long for any reason, right? They'll do 90%. They'll do 100% as long as your cash flow is improving. So basically it means that we have to either be dropping your rate significantly or consolidating a bunch of debt, right? Which is usually the case, right? Consolidating a bunch of debt. As long as your cash flow is improving, they do a net tangible benefit is what they call it. As long as that's the case, they'll go to 100% all day, right? So whereas when you're talking about conventional or FHA, you're 80%, you're limited to cash out and no exceptions, right? And that's it. That's all they'll do. So that type of flexibility is a huge one. I could do, like I said, I could do a whole video just on the underwriting flexibilities. I could talk to them blue in the face. I get pretty excited about that because truly it makes such a difference. I mean, when I qualify somebody that's a veteran and you come to me and you say, oh, I want to get qualified for a loan, and then you tell me you're a veteran, the number that you'll qualify for as a veteran will be anywhere from $50,000 to $100,000 more than if you weren't a veteran. The fourth reason. Now, this one's a pretty cool one. And this one's a little controversial, actually. You may actually hear if you're going to go sell a house that sellers don't like VA offers or a VA offer is not as strong. Let me tell you where that comes from. It's all about the appraisals, right? So back in the 90s, I'm old. I've been doing this a long time. Back in the 90s, the VA process for an appraisal was a lot different than it is today. We used to actually have a VA appraisal that was done. It would take like 3 weeks, and usually it was some VA veteran appraiser who was old as dirt. And they would do the appraisal, would come in weeks later. It would go to VA in Seattle. 3 weeks after that, we would hear from them. Very often it would come in low and we'd just be kind of stuck floundering, and everybody would be pissed because you're 4 to 6 weeks in now, and now you have an appraisal you can't use. And VA got a very bad name, and somewhat deservedly so, right? It was a very inefficient process at that point. They introduced what's called Lender Approved Processing Program, or they call it LAP, right? Everybody in the mortgage industry love our acronyms. So this was LAP, right, is what they called it. That changed everything, okay? This was in the late 90s. They enacted it, where it lets us as a lender underwrite that appraisal. It never goes to VA, okay? Since then, they've made several changes to the VA process that have improved it. And it's a night and day process now. So a lot of that reputation that VA loans or VA financing has gotten is really outdated. And people will say, oh, well, VA is weaker or lower prospect of an offer. Then they can't make sense of it, right? Because it's truly not the case anymore. VA offers are actually stronger. I actually did a video on this. VA offers are stronger than most conventional offers, believe it or not, because of these flexibilities. Now, the appraisals, there's a couple reasons why I want to talk about this. So the LAP process changed everything, right? Now, conventional appraisals after the crash had a lot of independence rules that came out, right? The Frank Dodd Act passed all these rules where so the appraisers don't get undue influence on them to come in at a certain value or to ignore certain work orders, right? So we're not even allowed to talk to these appraisers for the most part, right? Until after they've done their evaluation. And even then it's very restrictive, right? So VA is a little bit different though, where they went across the board where there's very little accountability now with conventional appraisers. I have more conventional issues on appraisals than I ever do with VA because the VA appraisers are still accountable to VA, right? So when they did this independence thing, they also created all these management companies that are like clearinghouses. When we order the appraisal, it goes to this management company, then they pick an appraiser. Anyway, so what ends up happening is the appraisers have very little accountability to us, right? Because, oh, if we ever question their work, we're just trying to, sway their decision. Well, that's not the case. We just want a quality appraisal, right? Well, the appraisers have this accountability to VA because there's no middleman for them. So two reasons. One, they have to answer to VA, plus we're getting higher quality product because the veteran appraiser, the VA appraiser, actually gets to keep all the money. There's no middleman that's taking part of the money, right? So if you're an appraiser, every appraiser wants to be a VA appraiser, right? You make more money by doing those appraisals, right? They set the fee. It's just set by the region. So as an appraiser, you get paid more and we end up getting a higher quality product. These appraisers typically have more experience. They're taking their time. They're doing a good job because they get rated on it. And if they do a bad job, there's a process to it. We have this reconsideration of value process that's laid out by VA. Where conventional, the process is not that clear. And actually, I can argue that they're disincentivized to ever make a correction on a conventional appraisal, where a VA appraisal, they are. And actually, even the underwriter has the ability to change the value up to 2% if they choose. So the appraisals across the board there's way more accountability. Oh, and add another cool thing that they did in the early 90s, the early 2000s, they passed something that's called the Tidewater Act. Now, the Tidewater Act is where if an appraisal is being done on a purchase and the appraiser is finishing up and he sees that the appraisal is not going to come in at sales price, that he's coming in low, right? On a conventional appraisal, we don't hear anything. They just give us the appraisal and it's like, go pound sand. That's it, right? Fight it if you want, right? Which is low chance of ever success, right? But with a VA, the Tidewater Act makes it so the veteran appraisal, the VA appraisal, has to notify all parties, the buyer, the seller, and the agents, that he is struggling with value or she is struggling with value, and give us an opportunity to provide comps, to be able to challenge it and to be able to justify the sales price. There is no other loan that does that. And if maybe there's something that the appraiser is missing, right? It gives us a chance to actually justify the price. And if nothing else, it gives everybody a feeling of being heard. So if it still comes in low, they can't argue that, oh, well, they missed everybody a feeling of being heard. So if it still comes in low, they can't argue that, oh, well, they missed this or they missed that, right? Because they had the opportunity, right? So the Tidewater Act is huge, I think. No other loan program will give us heads up and give us a seat at the table, right? When it comes to that final decision on value. I think that's just amazing. So because there's turn times that they're held to, they want to stay on that list. They're accountable to VA. You have the Tidewater Act. We're just seeing a higher quality and a more consistent product out of VA appraisers, believe it or not. So any of that bad press you've heard about VA, realize whoever's saying it does not have experience with VA, believe it or not. So any of that bad press you've heard about VA, realize whoever's saying it does not have experience with VA in the last 10 to 15 years, at least not significant enough, because if they did and they knew these items, they would realize that I have been able to pull out tough files at a much higher rate when there's a veteran involved than there isn't, right? Even with low appraisals, right? It's just easier to get them done. So that's number 4, big one, right? But not the best one, that's coming. Multiple loans. This is something a lot of people don't know, that you can have more than one VA loan. If you are active duty and you're stationed somewhere and you buy a house for your family, and then you have PCS, right? Change of station, and you're going to move across the country, right? You could rent that house out and then use your VA again and buy another VA house. You can do it a couple times. You can have 3 VA loans. You can have 4 VA loans, as long as you have enough eligibility and the formula works, right? Because after you use the eligibility once, you only have so much left, and it's based on the county. There's a formula to it. And if you ever want to know how you fit in it, just let me know. I can run the numbers for you. It's not rocket science, but there's a formula to it. But you could use your VA more than once. You can have multiple VA loans. Now, VA is an owner-occupied loan, which means every time you get a VA loan, you have to live in the house. It is for the purposes of you living in it as a primary residence. But that doesn't say that things don't change and you can't rent it out and go buy another one, right? It's not a one and done. A lot of people think, I've used my VA and I've used it up and I can't use it anymore. It doesn't work like that. It doesn't go away. And once you pay off a VA loan and you sell the house and pay off the loan, your eligibility is fully reinstated. Actually, VA even gives you this is how cool they are. There's always an exception to everything. They even give you a one-time exemption where if you were to buy a house VA and then either refinance it or pay it off, but you still own the home, they'll fully reinstate your VA if the VA loan's paid off. They'll do that one time. Now, after that, the VA eligibility stays with the house, whether you pay it off or not. But they will give you an exemption for that, where you can fully reinstate your VA one time. I think that is so cool. All right, save the best for last. So here we go. The coolest thing that VA does, and no other loan comes close, is not only do they let you go zero down, and not only do they let the seller pay all the closing costs and the taxes, insurance, and everything else, they even let the seller pay the buyer's debt, right? I'm not kidding. So very often, when we estimate closing costs, a big part of the closing cost is the timing of your closing. So if you close at the end of the month, your prepaid interest, prepaid taxes are different than if you close at the beginning of the month, right? Because it's all about when the first payment's due. So we could be off a little bit. So very often, if we have money left over on VA, I can say, okay, hey, John Q. Buyer, hey, send me your credit card statement. We're gonna put $1,500 towards your credit card, right? Or we're gonna pay off your car loan. They allow it, right? On conventional FHA, any other type of loan, it's reduce the price if you're lucky, or more often than not, it's just money left on the table that just goes unused. We can even negotiate going into it up to 4% for closing costs, an additional 4% towards debt. So now granted, you have to build it into the price. The seller has to agree, and that's the hard part, right? But if they do, and you have the right scenario, you could get up to 4% to be applied towards debt. That's a lot of money, right? We're talking, $18,000 or, $20,000 on the right house, 4% of, $500,000 house, that's $20,000. That could pay off a car. No other loan allows that, not even close. It's considered what's called a seller concession in every other scenario, and they increase your down payment dollar for dollar, not VA. VA allows it. It's my favorite thing about VA, and it allows us to be really creative at times. If the appraisal comes in a little bit high and there's some wiggle room there, it can really help out people and make all the difference in the world. So, all right. So those are the 6 reasons why I think VA loans are awesome. I think they're the best loan out there. You veterans have earned the benefit. It is well deserved, and I will do my best to make sure you make the most of it. and get what you deserve, which is amazing service and a loan that will benefit you and your family for years to come. So if you like what you heard, if you have any questions, comments, please comment. Make an appointment on the calendar. I would love to chat with you a few minutes and answer any questions you have, get you ready to buy now or in the future, or if you have a family member you're just concerned with, any scenario you have, VA or otherwise, I'm here for you. So John.Hunter, New American Funding. God bless you. God bless America in this tough time. Everybody stay safe and have a wonderful week. Talk to you soon. Bye-bye.